final statement that there should be a governance network to organize this debate, and I think this is the way forward. Of course, sometimes the discussion can take very long, and everybody is not going at the same speed. That can be a challenge. And in the European Union, we know what we're talking about in that respect. When we're preparing this panel, so we are switching to something slightly different, monetary policy. And when we're preparing this panel, it appeared that there's actually a joint theme. So Garrick, Robert, Paolo, Tomaso have all brought different work, publications, thoughts to this table. But actually, I noticed that there is a joint theme, which is financial stability, and how it relates to Bitcoin and digital currencies. So Robert, I saw that the discussion of Bitcoin, you had very interesting thoughts here. Especially, I liked the thoughts that there may be a link to or a possibility to get rid of some of the distortions that are currently in the financial system and that support too big to fail financial institutions. And we would, I think, be interested to hear a bit more about that. Garrick, you have proposed a first and an important approach to actually determine the growth potential of Bitcoin from a use perspective. So determining the value of whatever it is, because we heard there are still many opinions, whatever it is, a currency, a means of exchange, an asset, but to determine its potential by its uses, by the needs that it addresses. I think we would like to hear a bit on that. And especially since here the link to financial stability, where when the too big to fail, I think it's clear to everybody what the link to financial stability is. We have seen it in the last 6 years. But in the use case discussion of use and the discussion of Garrick, I think it's very interesting because here the financial stability concern at its source is sometimes poor, bad, and even oppressive policies that lead to financial stability concerns in the first place and may create a need for a digital currency to overcome and to counter, to build a countervailing power to these poor policies. And then finally, another financial stability theme is that we would like to take up with Paolo and Tomaso then in as well is this discussion about the volatility. What kind of volatility is actually the one that matters most for financial stability? And clearly financial stability is something, when we link it back to this discussion of the keynote just before, does financial innovation, does the financial system rather benefit the rich, the wealthy, or the poor? Clearly financial stability is something that is more threatening to people who do not have flexibility to protect themselves against volatility and financial risk. So it's a very clear concern here that more financial instability will always go against the weaker parts of society. So we had this discussion, again a link to financial stability. What kind of volatility is actually the most worrying one? In which part of the system can we better deal with with price volatility? And maybe the price of a currency is not the most worrying one. Maybe it's asset price volatility that is more difficult to handle. And there's the link with the recent need to introduce macroprudential policies as an additional tool to complement monetary policies to tame a bit in different parts of the financial system asset price volatility. So you see, I hope I made a bit the link. There is a common theme, a common thread, which is financial stability and the cost of financial instability. And I think to make this link to the benefit to society, to whose groups can benefit or have more at stake in that respect is very important. So if you agree that we take it from there, Garrick, I would give you the the floor and explain a bit more your approach.
Great, thank you very much. So I just want to provide a little bit of background so we don't get too bogged down in technical details and jargon, which I think non-economists in the room will appreciate, I hope. So a few years ago, right after speaking to financial stability, right after the financial crisis, after Lehman's bankruptcy, the Queen of England came to my institution, London School of Economics, and posed what's now been known as the Queen's question to the group of economists who were there. Why did you not see the crisis coming? And no one had a good answer for Her Majesty. So why is macroeconomics so hard? Why did the economists at the LSE and other schools, by and large, not see the crisis coming? There are people like Robert Schuller, others who arguably did, but by and large, the community failed. Well, Jan Hatsuis, the chief economist at Goldman Sachs, says macro is really hard for 3 reasons. Number one, we don't understand, unlike chemistry, we don't understand the forces of cause and effect very well in economics. That's problem number one. Problem number two, the data is extremely poor. The data is extremely poor. And I'm going to tie these problems in macroeconomics, by the way, back to how blockchain and Bitcoin technology can help macroeconomics, help us understand the economy better. But the data is very poor. What do I mean by that? We often don't know that we're in a recession until a year or more after the fact. GDP figures, which are extremely important to setting monetary and fiscal policy, are often revised in a material fashion for many months, if not years, after they're first reported. Data is a big problem. And then number 3, the third reason, is the economy is constantly changing. It's not a static thing. So we can look at things like how much income, for example, the middle class has been earning over the last 30, 40 years and say it's been relatively flat. But what we cannot do very well is compare the basket of goods that a person in the 1970s, from a quality of life perspective, could achieve or obtain with that income with today's basket of goods, which has things like iPads and iPhones that didn't exist back then. So fine, income's flat, but is quality of life, has it gone up? Is it better because healthcare is better? You know, the iPad is where we all spend our time, et cetera. So those are the 3 chief problems. Data is obviously, I think, the most obvious of those problems where blockchain and Bitcoin technology could really make an impact. You know, there's a wonderful quote by Dostoevsky about the irrationality of humans. If you wouldn't mind, I just want to read this real quick. So in his notes from the underground, a man may wish upon himself in full awareness something harmful, stupid, and even completely idiotic in order to establish his right to wish for the most idiotic things. Okay. Unfortunately, most economists who developed the efficient market hypothesis and the theory of Homo economicus, this perfectly rational computer person who is the agent, who sits at the center of most economic models, do not read Dostoevsky, or they would have never developed this kind of ridiculous person who a lot of economic models are based upon. And now we're having to unlearn this based on the work of Kahneman and Tversky, and the people who pioneered modern behavioral economics have taught us that people are more loss averse than they are interested in gaining, for example. So the blockchain could actually represent a wonderful natural experiment where we're learning a lot more about how humans actually behave. You know, we're getting much better data in real time with things like smart contracts, which could help us model more realistic agents in economic models. That's a potential huge boon for economics, I think. Obviously, the blockchain has real-time data. You know, the more we digitize the economy, the more accurate our data is going to be. These are all things that are going to really help economists try to predict the next crisis, if you will. I just want to talk briefly about government and regulation, then I'll turn it over. And this gets into financial stability. So we had a very interesting conversation over dinner last night about central banking and blockchain and Bitcoin. I want to believe, I am really interested in the possibility that just as we could have driverless cars, we could have something akin to a driverless central bank someday. All right? What does that mean? Well, Milton Friedman famously said we should replace the Federal Reserve or central banks with a computer. But it was a very simple computer that Milton described. It would basically just increase the money supply at a fixed rate at the long-term rate of growth of the economy, 4% back in the 70s, probably about 2% or 1% today, right? I'm imagining something much more sophisticated than this, okay? Something more sophisticated than the Taylor rule, right, which just says that basically if you increase, inflation goes up by 1%, you increase the interest rate by a little over that. That's the Taylor principle, actually, but very kind of simple rule. imagining something that actually fend off a speculative currency attack. That maybe has some of these Dostoevsky ideas of rationality built in that could actually somehow outsmart George Soros by being unpredictable. That can't be gamed. Peter Todd says this can't be built. Okay, so I have to find a developer other than Peter Todd to help me do this, I guess. But I think that's an interesting possibility, an interesting project. If you're interested in that project, please come talk to me. There's a few people who are interested in this. The other last thing I want to talk about is why would we benefit from having this kind of driverless central bank? Well, AIG, if anyone followed the news last night, just won its court case, Hank Greenberg did, against the US government. They argued that they were unfairly treated, that the government shouldn't have seized their equity. Why didn't they seize Goldman's equity or Morgan Stanley's equity? And the government agreed with Hank, but didn't award him any damages. Why am I telling you this? Well, I think there's a real lack of transparency into central banking, into how some decisions are made. Why Bear was saved, why Lehman failed. Why was AIG's equity seized where Morgan's and Goldman's wasn't? You know, could a more transparent, driverless central bank answer some of these questions, help us unravel the mystery around illiquidity versus insolvency? I hope so. Final point, AML gets talked a lot about, and this is getting off macro for a second here, but I really think we need to talk more about Bitcoin and blockchain as a vehicle for tax evasion. I think this is actually something that's a big issue. It's really going to concern governments. It goes to the heart of how governments are funded. I think they're willing to tolerate a certain round of black market activity, money laundering, but if you start having a big tax evasion problem, I think that's a big issue, and maybe that fits into this somehow.
Thank you. By the way, I'm a big fan of Dostoevsky, and I agree with you that actually in The Idiot, he actually discusses this thing that actually the society around this person, this a bit crazy noble person that in the end goes back to the Swiss sanatorium, his environment actually does not really understand why he's so freely giving to his environment all the time without asking anything in return. So it's really a nice discussion. On the other hand, I recently made the point on a panel on behavioral economics, what we can learn from behavioral economics for regulation. I contradicted a compatriot of yours, Alex Chesterfield from the consumer organization, because she used Homer Simpson as the counter-example to Homo economicus. and I contradicted her on the panel because I said, look, I mean, actually, you have to look what you put into the utility function. For me, Homer Simpson is the most rational person on the planet because he knows exactly what he wants and he does everything exactly right to get it. He wants to be liked by his people. The really irrational person in Homer Simpson is the guy who runs the nuclear power plant. Because he doesn't know what he wants, and he's very unsuccessful in getting it. But with that side remark, I give it to Robert.
Right, okay. Yeah, I'm a fan of Dostoevsky as well. And I think it was Friedrich Nietzsche said that the irrationality of a thing is no argument against its existence. And I couldn't agree more. And when it comes to questions of financial stability, it's important to keep in mind. I think a lot of the financial stability debate is very much monopolized by economists who come from a very different perspective of how markets work, very model-driven academic point of view, with equilibrium being the guiding principle of the reasoning. And I think financial stability discussions could benefit a lot from more contributions of people from outside the economics profession, both from complexity theory in computer science and signals processing, and of course, I think in the invaluable contributions of the people in my profession in financial markets. The issue of the driverless central bank is one that's also very close to my heart. I've done quite a bit of research on the concept of a stable cryptocurrency. The idea being that we can improve upon the Bitcoin protocol and its deterministic money supply rule by incorporating a dynamic feedback rule where the money supply changes with changes in demand to stabilize the coin. But instead of going into that most interesting idea of how to create not only a central bank governed by a computer, but a central bank governed by a decentralized computer, I'd like to briefly shed light on what I think is another really important dimension to this discussion, which isn't directly related to the blockchain and a lot of themes that people discuss in this context, but is very relevant and I think not looked at closely enough. And this is the issue of financial stability, leverage, and fractional reserve banking. One of the most interesting implications to me of cryptocurrency or digital cash in general, whatever its fundamental design may be, blockchain-based, decentralized on a proof-of-work basis, or a decentralized system with some governance structure around it, or even a centralized model. The very idea of a digital cash that is separate from the electronic money we have with the banking system is a really profound idea, because what most people don't think about is that when we talk about money and we talk about fiat currency, I'll think, well, fiat currency, it's printed by the central bank and that's the end of the story. But that's actually not how the system works. We actually have two different forms of money. There's the money that's created by the central bank money, and there's the money that's created by commercial banks. There's commercial bank money, bank deposit. And the vast majority of the money supply, over 90% of the money supply in any developed country, is commercial bank money. And commercial bank money is
97 in the euro area.
97 in the euro area. So I mean, commercial bank money is categorically different from central bank money. Central bank money is the ultimate risk-free asset. It cannot, by definition, default. Whereas commercial bank money is an unsecured credit to a private institution. And one of the reasons why this system of fractional reserve banking is so pervasive is because there's no way to avoid it. Unless you're a large financial institution, you do not have access to central bank money. It's a privileged coterie of financial institutions, mostly bank holding companies, who can settle trades using counterparty risk-free central bank money. The rest of the world has to move money through the banking system, no matter who you are. And technically, there is no reason why that needs to be the case. And there are various initiatives within the central banking world for liberalizing central bank money. But what I'd like people to think about when they think about cryptocurrency, because cryptocurrency is like central bank money, free of any counterparty risk, is what are the implications of a world where digital cash, cash that is completely independent of bank deposit, what would that world be like? And I would argue that the very possibility of creating digital cash that is outside of the banking system, will ultimately have the implication of bringing about the demise of the fractional reserve banking altogether. Because when you think about it, if you have an alternative to making payments on a counterparty risk-free payment rail, why would you ever use a bank deposit? And most of the reason why economists look at this issue and they say, well, people put money in bank deposits instead of holding it in cash because the bank will pay you interest on your deposit, and that is part of the relative demand between cash and bank deposit. But for the reason why people have bank deposits is because you need the efficiency of an electronic payment rail. You can't use paper cash. opportunity within the cryptocurrency and blockchain discussion to widen the constituency of interested parties in this space by also talking to the people on the financial stability side of the discussion who are interested in improving financial stability by radically reforming the banking system and phasing out fractional reserve banking.
I would actually like to ask a question exactly related to that, but to the whole panel. To what extent do you think is the deposit guarantee, the state deposit guarantees, an obstacle on this possible road to more use of digital currency? Because I mean we had a discussion in the immediate phase of the crisis. It was an effective means to reassure people, to avoid the physical run on the banks while we had the run in the wholesale markets. It was quite effective in the immediate aftermath of Lehman.
Mm-hmm.
But now, I mean, it's part of these distortions, right? That give deposit-financed commercial bank credit the edge over many other technologies, because you just completely eliminate the risk for the first 100,000 euros in the case of the euro area. What are your views? To what extent the deposit? I mean, Paolo, you are exempted if you don't want to reply. But what are your views? To what extent this is an obstacle actually to go to the situation that you just?
I would say that there's no doubt that if you didn't have publicly subsidized deposit insurance, that there would be greater demand for other forms of electronic money. But deposit insurance is geared towards mostly cover the widest number of depositors rather than the aggregate value of deposits. So there's a cap on which varies from jurisdiction to jurisdiction, but it's usually no more than $200,000 of how much deposit insurance you can claim. So there is a substantial amount of non-bank cash within the system by institutions that do directly assume the credit risk of a bank. And that's where, and as a result of that, I think probably where we will see innovation in the commercial bank risk-free cash coming from the institutional side of things rather than retail payments.
The only thing I'd add is I was at Lloyd's of London last week. We released a report on kind of risk factors from the insurance perspective. I mean, already a number of Bitcoin companies are engaging insurance companies to provide effectively deposit insurance. There can be private sector solutions to this. Yes, it'll cost more than, say, public sector subsidized deposit insurance, but I think the private sector can come up with solutions around that.
I believe it will be most on people perception, so how much you perceive on the long run the stability of the cryptocurrency, and it might be, I'm not exclude that in the long run the perception will be that it's a very solid and robust kind of investment, and therefore, I mean, it might be perceived stronger and more secure than putting your money in a bank that can't fail. Instead, I mean, how much you trust the blockchain and the system might be larger actually than the trust of a bank or a state.
I mean, we have tested a bit this link in spring 2013 when both capital controls were imposed on Cyprus, and when there was a discussion how much of bank depositors, how many, to what amount bank depositors can be built in the rescue of a financial institution, and I think there was a substantial move into Bitcoin at that point in time.
I just want to speak to this because I actually 2 weeks after Cyprus was invited to the Bank of International Settlements in Basel to attend the International Association of Deposit Insurers conference, annual conference. Great timing. And the FDIC was there. Thomas Honing, former member of the Fed voting committee, who's now vice chairman of the FDIC. It was just complete pandemonium. I mean, basically everyone was like, well, they've ruined it. We spent all these decades convincing people that the emperor has clothes, that there is enough deposit insurance to backstop the banking system, and in just a flash, that's been completely erased. So it's a bit of a shell game here, deposit insurance. I think is the important thing to remember. When a small bank fails, it's fine. They can mop that up. If there's a systemic crisis, then it's the Treasury ultimately that's going to stand behind the banking system.
Maybe let's take it to the second part, financial stability. And by the way, Robert, I think you mentioned Milton Friedman, right? I mean, you could also take Milton Friedman's rule to actually not allow the central bank discretion over the growth rate of the money supply. Today, there's a modern reincarnation of this discussion, in the sense that we have seen that the Federal Reserve, using quantitative easing to alleviate the cost of restructuring and to lighten the cost of deleveraging in the U.S. economy, they accepted a very large negative externality by the fact that much of this liquidity went out of the US very quickly and went into emerging markets, and countries like Brazil had to implement quite drastic measures to stabilize their economy that were destabilized by the very strong inflow of money. Tomaso, so if we think about price volatility of different monies as compared to asset price volatility in areas where it is probably more difficult to run and to seek cover, like real estate markets or destabilization of entire national economies, where should we put the emphasis?
Let's say, I think that from, let's say, an ecological perspective, the fact that having diversity is supposed to increase stability. This is, as all paradigms should be taken with a lot of care, but it turns out to be true in many systems, and they might very well be true in the monetary system. So the increase, actually, the explosion, probably a very large number of cryptocurrencies, it might be a very good thing for the stability. On the other hand, I think that the peer-to-peer level and the fact that to some extent, the absence of intermediation, it's very likely to increase the herding kind of behavior. So this irrational movement in bubbles and bursts, driven by what you said, the idiotic behavior by the Simpsons kind of attitude and behavior. Well, probably Simpsons will not do much in this sense because he's rational, as you pointed out. But the owner of the nuclear power station might actually act very rationally. And on the bottom of this, I think there is a very important fact, which is what is called the information asymmetry, and which of course it will increase in the sense that individuals cannot access to the whole, to the amount of information that institution and more powerful instrument to get this information. And this can be quite big because it's not only about information, so being informed of which is the best investment for you, which is the best currency to hold, but is also technology. And of course, here we are talking about cryptocurrency. Cryptocurrency need little technology to be moved, but clearly also they open a space for large technological investment when we are talking about speculations, because they will be cheaper and faster to be traded electronically. And then this will put off a lot of individuals, because if you, we see already now, people that co-locate servers in stock exchange to get the advantage over the 40 milliseconds that takes for somebody on the other part of the globe to to do a trade, and they make not huge but substantial money out of it, and all this money come out from somebody else. So in this sense, I mean, if you don't have that technology, most likely you will lose something out of it, and this is a worry. I mean, it's not necessarily a huge problem, but I mean, it's something we should consider in this community and in the governance or regulator community, because this could be a strong disadvantage to individuals, to people. And then volatility. The fact, I mean, there has been an ongoing critics on Bitcoin in particular, that is very volatile, so people, I mean, one might not trust or might not use it because the volatility. But volatility in itself is not necessarily a problem, and actually traders love volatility. I mean, it's, anytime there is volatility, everybody's happy in the city. Of course, because it gives you way of doing, well, gives you way to make money out of the change in the value. The reason why traders like it and the banks and large investors don't mind it is because there are a lot of instruments to hedge the volatility. So in the sense, you can still make riskless or small risk investment, even if the underlying value change a lot. But this again go back into the information asymmetry. Single investors that hold the little portfolio in their pocket, they might not be able to access financial instruments, which are not particularly sophisticated, but sophisticated enough to not be easily implemented by individuals or implemented well by individuals. And therefore, I mean, this will be most likely, again, not in itself a problem of the currency if large volatility stays, but it will be a way for a new financial sector to drain profit out of the system. This, if we believe that real economy can get to equilibrium and in some rational way, this might not be, in an absolute sense, a bad thing, because given that the marginal cost of the marginal income, the marginal rates from third parties, from services, will be very, very low, because essentially in the moment in which you can negotiate electronic by yourself, this money you don't need intermediary, then I mean this large volatility might be actually the mean for services to self-fund themselves, and so I mean it could be actually something that would be a way for the whole industry to stay in place. And I mean, although I mean we tend not to like too much the financial industry, because of course it's speculating with our money, but I mean, in some cases it is useful, and therefore, I mean, it's something that it will be necessary anyway, because it's necessary for credit, necessary for large movement. I mean, it's very, very difficult to do these things without a services industry in the financial sector.
So I think it's a very important reminder that you put out here, Tomaso, because it is easy to say that we should all become more like option traders, that we should learn to benefit from volatility as Nassim Taleb is preaching it. It's easy to say, but it's difficult to implement. It would probably require a whole reorientation of the way we educate our kids from early on. This is not what we teach people to do. We are rather risk averse. We dislike volatility.
Yeah, also, I mean, we might not want to do it, because I mean, one thing is having money in your pocket.
Maybe we don't want to do it. Maybe we just want to sit in the garden on the weekend when the sun is shining, and not worry about volatile asset prices.
Exactly.
Paolo, Germany was one. Germany in 72, before the oil price shock, was in a similar situation as Brazil in 2009, when the Bretton Woods Agreement that Alex reminded us of, when the Bretton Woods Agreement lapsed in the summer of 71, a huge amount of dollars, expecting a large depreciation of the dollar vis-à-vis the other currencies, flew out of the US into Germany, completely destabilizing the economy, and the German Bundesbank, your boss, had to push Germany into recession before the oil price shock actually hit. And Germany was the only country in recession when the oil price shock hit the rest of the world. what should we care about? Which is the real type of, which is the type of financial instability that we should care about most?
So, first of all, whatever I will say is my own opinion, is not the opinion of the Bundesbank. I don't have much to add. I mean, my colleagues here on my right, they touch different aspects, and I think that I take your consideration about volatility, about money flow, capital flow, but I would like to go back to blockchain, because we are in the blockchain workshop, and therefore we like to understand how blockchain can help on this. And I don't have a clear idea. I mean, I see there is potentiality to exploit volatility. There is also a threat for people that are exposed to volatility, of course, if they don't have instruments to hedge against volatility. How blockchain can help in this domain: asset price volatility, currency volatility, how to maintain the purchase power parity. I think there is a trade-off, fundamental trade-off between the flexibility and the controllability of the system. So, governments usually want to control, oversee the systems and control the money supply in order to be flexible whenever they think is good time to shock the system with positive monetary policies. This flexibility and controllability is the two faces of the same medal, and you can do that in a discretionary with a discretionary approach. If you instead put some fixed rules based on the blockchain technology code rules, well, you break these two aspects of the same medal. You break the flexibility and you break the controllability. You may have controllability, but you don't have flexibility, or you may have flexibility, but you don't have controllability anymore. Other things that you will end up with a controllability, and you will lack of flexibility. So I think that it's very unlikely, so to say, that monetary policy will be replaced by a fixed amount of money raw coded by a computer, as Milton Friedman was suggesting back to '82. Although it's true that it's not given for granted that the currency, fiat currency, is the best currency in a country. We have the example of Zimbabwe, which country back to 2009 changed its monetary system to a multi-currency monetary system, and now basically they're using dollars and euro. One thing, so to say, is the means of payment that you use in your market. Another thing is how you basically control this money supply. And I would say that I'm more in favor of, personally speaking, an Hayek approach, where you see an economic system or economic systems based on different values, different market mechanisms that adopt different currencies, maybe at the same time, simultaneously, in terms of currency competitions, that currencies that follow different monetary system, money supply mechanism to meet some specific needs of members of the communities, or specific sub-community within the same community. So this is I think the way in which the blockchain can help and can be used. So I don't see a blockchain fixed rule for monetary for a single monetary system that can be replicated from one country to another, but I see basically different monetary rules that can be applied within even the same country. The point is that the problem in this exercise, we need always to consider that there is the method that we need to keep controllability and flexibility. Because if you want to shock the economy, like we are doing now in Europe, you need to act.
Can I follow up on that? I mean, I think, first of all, on the question of flexibility and control, there is something, it's not really a binary thing. I mean, it's more of a spectrum. But I think to have a rules-driven monetary policy or any rules-driven system doesn't mean that there is no avenue for overriding and changing what the rules are. I think one of the things that blockchain-based technology allows is a formalization in a very transparent way of a rule-driven process that can have overlain on top of it a governance structure that allows the rules to change, and that seems like a very sensible type of framework. But going back to the
problem is the following: flexibility in terms of action that are not expected by the households. So it's not a term of the capability to change the code. It's the term that you need to shock. A shock is not expected.
Yeah.
You cannot code a shock because otherwise the rational agents anticipate that you will do a shock whenever something happens.
It's a long-standing debate of rules versus discretion in complicated dynamic systems like monetary systems or markets. But I think that the debate, which again is usually dominated by economists who work closely either from the academic side or from the policy-making side closely with central banks, there is a bias in favor of the notion that there's some inscrutable value that comes from the human discretion in the policy-making, whether it's from being able to outguess and spoof the market and get a temporary hit by thwarting expectations, or whether it's some inscrutable judgment that can be made that can't be formalized into rules. And a good empirical example to this is in trading. And this is an area where a lot of people have the view that there's something special about the trader's ability to synthesize information coming from different sources, charts, fundamental information, and the like. But the empirical track record on rules versus discretion in trading is pretty compelling. That whatever people think the expert judgment of discretionary expert decision making brings to the table, it's a lot less than is actually the case.
I think I like this point that you say on trading. What do you do in trading and in finance? Very often you want to benefit from a particular financial instrument. You want to benefit from a particular financial debt instrument, for example, because it has features that matches your current needs with an investment project, with something. So you buy in flexibility, and very often you in the current financial system, very often you pledge actually cash. You pledge cash in order to benefit from the flexibility of a debt financing instrument. So actually, when we link it to the discussion yesterday that we had on Primavera's new monies, isn't that a real possibility? Because digital currency, even if it's a very individual currency, even if it's a currency that only has functional value as means of exchange, store value within the community, could it be useful as collateral? Could it be pledged as collateral? And I think the condition we would look for is how important is the element of transparency, in qualifying for a collateral. The collateral is something you pledge, but typically it does not leave you. I mean, eventually you take it back. So if the transparency is actually the overriding feature, that makes cash such a popular and acceptable collateral, where only government, highly liquid government bonds are probably the next category. This could be.
I think it's another dimension that that the transparency that blockchain can potentially bring is the use of a cryptocurrency or some other digital asset, whatever form it takes, use as collateral. Because one of the advantages that transparency that the blockchain provides is that you know how that collateral moves throughout the system. So what happens in the actual financial system is that collateral gets rehypothecated. So when you deposit your securities, with a custodian, unless you read the fine print and negotiate certain types of agreement, that custodian usually has the right to re-lend your asset out to somebody else. So you think that it's safe in a box somewhere, but in actual fact, you get something like a fractional reserve banking system building up within the securities market itself. And if you have a collateral management system that is based on a transparent blockchain system, the nature of rehypothecation, the extent, the topology of it throughout the financial system is completely transparent to everybody. So it certainly has the possibility of creating a collateralization mechanism that's better than any that we've ever had.
I find this very interesting, because we talked about this problem that many things do not get measured as long as we try to measure them in the current established forms of value-added productivity, and that we measure them in the currency of the country. But actually, just for being able to increase your collateral, your individual collateral, your loanability, your capacity to get credit, I mean, it should be perfectly fine to have something that I can pledge to a space like the blockchain that's perfectly transparent, and that where there is no where there's what do you think, Garrick?
Well, one really exciting idea that I've seen come out of blockchain innovation is this transparent balance sheet initiative that I think BitReserve is responsible for kind of first pioneering. I mean, I have some questions about how you audit or trust the numbers that are being reported, but if that problem can be solved, I think this is a potential game changer across all corporations. My first job out of university was as a merger and acquisition banker. I went into a meeting with a couple publicly traded companies right for the end of the quarter. Basically, one party said, "We need $10 million to meet our number. Tell us what you need to cut a deal." I mean, all this kind of window dressing that goes on at the end of quarters, really problematic in terms of systemic risk and financial stability. At the same time, from the central bank's perspective, if you have a fully transparent bank balance sheet and you're watching a run on that bank happen in real time, that of course can trigger further problems. So how do you manage that aspect of this, where when the central bank needs to lend privately, quietly to an institution that's in trouble to stem a problem, maybe a transparent balance sheet isn't a great solution. But I think there's some real opportunities here in terms of increasing, transparency through the use of blockchain technology.
I think that this is true, but this is going to be probably the biggest threat to blockchain, because as you know very well, banks and financial institutions are reluctant to release any information to outside, including to central banks.
Yes.
And actually, in a completely rational way, right? From an academic perspective, we cannot get information even on what happened 10 or 20 years ago,
Mm-hmm.
which of course have no commercial value whatsoever, but they probably, they are afraid they might uncover, behaviors that were not exactly, either ethically or legally correct at that times. But anyway, so this would make a huge change in the system, which of course will find a huge resistance from the system, and the system is quite powerful. So in this sense, this is something we should all consider, because if we really think to go for a transparent, of course, blockchain can be also be non-transparent, so transparent to only to a small group of people. But
and you mentioned earlier the information asymmetries. I mean, the information asymmetry is one of the most powerful forces that supports the intermediation. Because when you think about what a bank is, it's got loans on the asset side, and it's got deposits mostly on the liability side. And there's no reason if the cost of contracting is low enough that the loans can't be originated by somebody else, securitized, and financed with repo financing on a blockchain network, and you don't even need the intermediary of a bank. But it's the information asymmetry is what the bank brings to the table. It's the edge that it has, and it's what supports the institutional nature of it.
Well, they do something more a little bit. They do also liquidity transformation and maturity transformation. This is something that I don't know.
No, but maturity transformation, I mean, you could securitize a loan, and you could sell it to the market, which it could finance a short-term repo. So I mean, so asset markets plus repo can do maturity transformation without
you can do
without
whatever you want with the blockchain, but the bank's needs, back to the many centuries ago, was indeed to do liquidity transformation, maturity transformation, and yes, the asymmetry information. Then we can discuss how to use and when to use the blockchain. And we may have different domains. We can replace some bank functionalities. I'm not believing. I'm not believing. I'm grew up. I'm not believing in a world where we don't have banks tomorrow. Maybe in the future, but it will be something.
Well, I mean, listen. I mean, the arguments for the intermediation in the past have always been there's something that the bank brings to the table because it has this relationship with its customers and it can assess the credit risk better than the market can itself. But when you have like one of the most popular themes in the fintech space is banks using big data analysis on public data in order to price credit risk better. I mean the idea that the bank is today bringing some special knowledge about its clients that can't be accessible to the outside world. It's a much less compelling story. So I think most of the information asymmetry that the bank brings to the table is can be avoided, and it's engineered by the banking institutions themselves rather than something inherent in the system.
It's a big discussion. We have to continue that. I think what we actually measure and what the banks are actually doing in terms of screening risk. It's an interest. Shall we take the question here?
Sure, thank you. For my sins, I spent some of the 90s building cryptocurrencies and fighting the central banks, and especially the Bundesbank, who claimed that monetary policy was very important and therefore only banks should do digital cash. They won that war and Europe lost digital cash. However, now we've got actual evidence. We have a large-scale independent money system called M-Pesa in Kenya, which has put independent non-bank money into the hands of the people. And the evidence is pretty clear that this has been a complete and unmitigated good. The people are able to do more trade, the wealth has increased, and even the banks have benefited through increased deposits and increased accounts. There's almost no evidence at all of any problems. So if we now take this large-scale experiment across to something like the blockchain, is there any reason to believe that the same thing won't happen if we have open blockchain money, increased wealth, increased transactions, increased benefits, increased transparency? Is there anything wrong with this, and why are the banks and the central banks ignoring the evidence of M-Pesa?
I think
this question from me. I think.
I think it's a very valid question, and if you look at what is currently happening, people are getting together and founding new types of banks. There is in Belgium a very interesting initiative and very courageous because it's one of the most impenetrable markets in terms of getting a banking license. And nevertheless, there's a large group of individuals who said, we do not think that the current banks channel our savings to the places where we think they should go. So we want a bank where we determine together the bank charter in a collective decision. I mean, in a town hall meeting space. Because we think we actually know better where our our savings should go to in the local economy, financing projects in the local economy. And clearly there is a big problem. There is a big problem with the current way financial intermediation is happening. The savings, the deposits do not go where people actually understand with just, you know, I mean, the man in the street, you don't need a PhD in economics, where there are opportunities to be financed, where people would be able to realize a project even if they had to pay 7%, 10% for a 5-year loan, and the banks are not giving this money.
So I think that going to the comments. So I fully on board. With you. I mean, we're talking about remittance industry there, and is disrupting. I fully agree that we should move to blockchain ledger. I'm not sure about the fact that banks will disappear with the blockchain, because Bitcoin is considered as a currency, and whenever there is a currency, there's people that want to profit from this, and there are already services by some Bitcoin players that offer lending. Terra Exchange is offering lending program to other players in the market, and other companies like Be Reserved is a kind of first experiments of fractional reserve system in the Bitcoin community. So you will have the future banks based on Bitcoin. In Switzerland, there have been a couple of weeks ago a request for a license for the first Bitcoin bank in the world, in Switzerland. So banks, is a way to gain money. I mean, also the peer-to-peer lending platform, that is how to allocate properly the money from borrower to lenders, is extremely good opportunity for overdraft borrower. Is extremely risky for the lenders that are inexpert and they need to build their own portfolio by themselves. So I see there are a lot of opportunities. There are some risk when you shift with the technology the banking activity to the consumer, to the retailers. So retailers becomes at the same time lenders and borrowers, and since they are not specialized, there could be some problems, and there could be some problem because there is no regulation to protect them.
Let's take another contribution from the floor.
Hey, so I think this is a really interesting discussion. I particularly like the idea of an automated central bank. I think that's really interesting. I think that there was an interesting discussion, and I'd just like to kind of pose this point. So between the need for control and a decentralized system. And I think that, and kind of implicit in that argument, was that there's some lack of human judgment that can be built into software-based systems. But even with self-driving cars or other automated systems, it's not like these cars are driving without any human supervision, any human input at any point. There's definitely a way to factor in human judgment to certain points. So you can have software that pops out, and then humans can input decisions in that regard. The second thing I thought was interesting was the idea of shocking things. Software can be just as random as human beings can be. So you could use the ability of randomness to actually induce a shock if you needed to. So people can't predict it. Maybe it's in a certain range. Various things like that. The third point is New York has the first Bitcoin licensed bank. So just a point out there.
New York is always the first one. Okay, I think we will leave it here.
Sorry, I have a last little question. Really short. It's a pity because we actually tried to invite them. It's the project Koina, which I guess some of you knows, which the idea is to create, by using the blockchain, some system for business-to-business internal currency, which is all compliant, allegedly, to the international law. So what I wanted to ask any of you is, now that we are entering into the peer-to-peer economy where individuals are also creating value, then would it make sense to, at the actual regulatory level, to actually allow individual to also, or community, or whoever is actually creating value, to also have its own internal system of internal currency that they can then trade either with themselves or with the other people within the community or intra-different communities?
So I'm not sure I got correctly. So you're talking about a system where you have basically a self-regulatory organizations within communities. We don't need a centralized governance.
I mean, basically expanding the model of Koina, or like all those, for example, in Switzerland, I know that there is this internal currency for buildings, for the construction of buildings. So when you have those internal systems which operate according to their own currency, then now that there is more and more opportunities for individuals or for communities to also produce value, then would that make sense that those communities can also use their own internal currency, which eventually can become broader and to trade between different communities with their own currency?
Yeah, I think this is a good first experiment. There are, I mean, I think is promising. Is a way maybe we could invest more time on understanding this alternative economic system, if you want. Yes, I think is a good way. I don't see any challenge from consumer protection, to say.
It is voluntary anyway. So I mean, I think communities will choose whatever technology they find most convenient for them. And even if you have, I saw that in your paper you mentioned the Chiemgauer. I mentioned it to Primavera yesterday. I think it's a secondary question what kind of technology the community is using. The community may choose to use a paper document if that is the most acceptable means. After that, you can still, if this is a very transparent system, you could still leverage that with technology, from there. So at which level the technology steps in to leverage such a community-based value creation system, I think is a secondary question. And the important one is to find a transparent means to document the creation of value. And currently, we are not very transparent in our system in general. And if you take a bank, for example, a bank has different forms of profitability. The profitability to its shareholders is a different concept. The profitability to the taxpayer, to the taxman, is a different concept. The profitability to the banking supervisor is still another concept. So there's one bank and at least three different types of the way you measure its profitability. So I think the other point is that I would like to take home from this panel is the point you made, or also the warning on tax. Taxes finance public goods. Any attempt to use technology with the overriding objective to get away from tax, from contributing to the public good, also via taxation, is self-defeating. I would fully agree with that. This cannot be disruptive in the sense that you just don't contribute in this channel. After all, there is a fundamental link to democracy, the way we currently understand it, and I think we have to go step by step. So I would like to thank the panel and give the floor back to our organizers. Thank you.